Noah, welcome. I'm happy to have you on because you have a very important and unconventional background that most people don't know about, such as like knowing about game theory and nuclear engineering. So, how do you explain what you currently work on to someone who doesn't understand what those things actually mean?
Uh, I explained that I'm working to upgrade economics.
Meaning like make it the economy more efficient.
Yeah. I find that that's been the most effective hook I've been able to come up with to get them to ask questions to then move forward. Uh, because this is a pretty unique circumstance. A structural upgrade to the mechanisms we use to make marketplaces hasn't occurred in centuries, and the math and physics and technology that allow for those kinds of structural upgrades to even occur weren't invented until about 70 years ago.
Got it. So like what specifically are you working on within the markets?
So I have a system I call coordinated discovery markets.
Hmm.
It is based on a new mechanism that provides the core business of the marketplace. That is price discovery, proliferation, and deal settlement. Uh, and it effectively replaces the role that futures markets play for commodities trading with a system that uh, breaks the deal in a different way that makes the entire system much more efficient. Existing futures markets basically divide deals into buyers and sellers and let each person write half the deal. And when two deal halves sort of match up, then they'll be combined and published. I break the deal into three pieces: a producer, a consumer, and a negotiation speculation role.
Hmm.
And I can, rather than having to make individual deals stitch up by doing it this way, I can allow aggregate deals to conglomerate together. And so this allows the entire marketplace to pull in and centralize around a common understanding of a common circumstance. And that's effectively the entire point of commodities in the first place. By making the product substitutable, it doesn't matter which of the counterparties is servicing your particular order, because everybody's money is the same and everybody's product is the same.
So essentially what you're doing is, as of right now, when someone goes on, let's just say Robinhood and buys something, they're either buying at the bid or the ask, depending on their if they're buying or selling. So you're adding a third variable to that transaction to make sure that companies such as I'm gonna throw Robinhood under the bus because they don't have the best reputation, ensure that they're helping the people who are making the transaction get the most fair price for the least amount of costs. Is that what you're talking about?
Yeah, absolutely. And Robinhood would actually be an excellent example of a company that's doing precisely not that, because they're allowed to offer their apparently free service by selling your deal information, which allows people with deep pockets to essentially manipulate the bid or ask ahead of your order be, being serviced and winding up costing you more money than if you had been able to access a marketplace directly.
So this has to do with like market makers, and I remember that's how I know this isn't a probably an apples to apples comparison, but I know that's how Bernie Madoff got his he like gained a good reputation because he was buying when people weren't buying during the financial crisis, and people are like, "Hey, he's a market maker. He like is doing what he's supposed to do," versus everyone stopped picking up the phone and taking the orders. So with companies like Robinhood selling the information and maybe manipulating the bid ask spread, it's actually not free. And that's the problem.
That is the problem. So to put this in perspective, people normally think about the transaction costs in terms of the market imposed fees. To put a kind of number on this, the CME Group is the primary commodity marketplace in the country, and their annual revenues are in the neighborhood of a little under $4 billion. And that's not pure commodity transaction fees. They also are one of the world's most important clearinghouses for international currency exchange, which is larger than the entire global economy. So they're getting a lot of fees from that as well. But let's say all 4 billion of that was commodity fees. U.S. government figures suggest that the total commodity transaction costs in the United States alone are on the order of $1 trillion a year. So the costs that are being imposed on farmers, loggers, miners, factory owners, and so on are roughly 200 to 300 times the fees. And those costs appear in that they don't actually trade at the ideal bid ask spread because they don't have enough information or liquidity to be able to force that condition. And so they get effectively taken advantage of by people who find ways to take advantage of them.
I think we're seeing this somewhat in the like the phone space. Like we're starting to see a lot of like new phone companies come out for a lesser price than the large ones, such as like AT&T and T and Verizon, because the cost for them to get you a new phone number is actually not that much money, but they're marking up that service substantially. And now you're seeing a lot of like Cricket Wireless, and I know Ryan Reynolds, like I think it's called Mint Mobile, like they're starting to undercut the price because of the price gouging that's been going on. Is this kind of what you're looking to solve in the financial markets, just to make sure if I go and
Uh,
buy one share of a company, I'm getting the best price that someone who's managing billions or trillions of dollars is getting?
yeah, substantially. So, if you think about network effects, and markets are very much network effects, everyone's kind of familiar with monopoly concept, where if somebody was the only supplier, they would be able to restrict supply in order to collect more money than they probably should, and sort of lord over shortages to make people desperate so that
Mm-hmm.
they'd pay the inflated rates. There's another much less well-known concept called monopsony, which is basically the reverse, where there's only one actual buyer, and so everyone that's in a position to sell effectively has to have the same kind of situation. They have to toe the line to whatever requirements that exist. But if there's only a single channel of trade, which that word doesn't exist yet, I'm thinking about maybe inventing it, then that channel can actually apply both ends of this. They can apply monopoly-like behaviors on the buy side and monopoly-like behaviors to the sell side, and essentially grow in at the cost of the broader economy. And what we've seen since the 70s is a financial system that has not merely been growing in its total revenues and profits, but one that's been growing relative to the size of the economy that it is servicing. And the reason that that has been able to happen is that computers are much more advantageous for these market insiders and market specialists in manipulating and using the marketplace than they are to the user customers, basically the rest of us, in unmanipulating and acquiring best possible deals from the marketplace. And that's not going to change because it's a structural feature of the market. The market didn't evolve and wasn't designed to cope with this problem, because in northern Italy in the 1200s, computers and the internet didn't exist, and nobody cared that the system was broken once those things were invented.
Got it. So markets have become a lot more efficient because of technology, and that's like a good thing because anyone who has access to the internet is able to open up an account and start investing quite easily compared to 50 years ago. You had to find a person, open an account, and
So
there's a lot more red tape.
right. I would have an issue. I would say markets have become much more accessible, and that is a good thing. I would say that they've unfortunately become much less efficient. And so if we can pair the accessibility that modern communication technology affords us with the kinds of efficiencies that modern communication technology affords us, then things really start changing in a big way. Because $1 trillion a year is it, again in the neighborhood. It's a little bit less, but not a lot less than the entire profit stream of the entire commodity production system of the United States of America. And so, if that cost were to be dropped by some considerable factor, the profits of farms and factories and so on could go up by dozens of percent across the board.
Mm.
And that would radically increase the amount of economic activity that we would actually be able to engage in. Uh, I estimate conservatively that if this system were to take over for the current, clunkier systems, that it would roughly double the total wealth of the country.
Who would it be hurting? The companies that are
The,
profiting
the
off of this?
the primary people that would be hurt by the adoption of this system are the people that are providing the credit to the people that are harming the existing system. So
When you say credit, you mean banks?
uh, there are banks, but there are other kinds of entities that engage in this behavior. So I'd mentioned before that the global currency exchange markets are larger than the entire global economy. The way the markets currently work with the futures trading contracts flying out there is that they actually trade a large multiple of the underlying good. So it's not, I've got a train card of wheat and then I find you and you need one and I sell it to you. I sell it to somebody notionally on paper and they sell it to somebody else notionally on paper, and it goes through 40 or 50 hands and then you buy it from them. And so each one of these looks like pretty good deals with very thin margins, but because there's so many of these deals, there it's not actually that thin a margin once you add it all up. And that means that there's essentially this paper or shadow economy that is many times larger than the actual economy. Now, of course, it's not real, but in order to back all of these plays, the somebody has to sort of put up the cash, not for very long usually, but it needs to churn, and that's a considerable source of revenue and income from deep-pocketed institutions, including banks, that provide this service, and it's also where the real major risk comes from when these markets fall apart. Because as we saw with things like the dot-com boom, the global financial crisis, other major, shreddings that have occurred since then, uh, because more than the entire economy is at stake, if they get off the rails and get off the rails by a wide enough margin, then suddenly there's a hole that's larger than the total value of everything that exists, and that hole can't be filled anymore. And that's when governments start, behaving radically, and businesses start getting a little crazy. And that's effectively been the story of the last quarter to half century, because we've been doing this a lot. actually.
I'm not sure why, but the first idea that like popped in my head when you're saying that was like money laundering. Like I have dirty money. I'm gonna put it into this clean business. If I put in $1 into this business, I'm getting 80 cents on the dollar of legit money, but I need to like put it through this system. And essentially by the time it gets to the end, it's manipulated in some sort of way, but it's hard, very hard to track like
So
where
it
it
is
came from.
actually well known that there is some amount of money laundering going on through the commodity markets. It is completely unknown how much money laundering is going on through the commodity markets because it is so trivially easy to do that it's virtually undetectable. There's one pretty straightforward mechanism that you you can sort of detect because it shows up as people being uncommonly good at trading. But let's say uh, I was a broker dealer and I wanted to give you some amount of money that we didn't want recorded as me giving you some amount of money,
Mm-hmm.
i.e., money laundering. Um, let's say $100,000. Well, the futures markets are effectively a betting market. So what I could do is simply buy two contracts, uh, one of which will earn $100,000, and the other one of which will lose $100,000 by the end
Mm-hmm.
of today. And you could become a client of my business, and I would buy these contracts, and at the end of my business day I would assign the contract that earned $100,000 to your account, and you have just made a brilliant trade, and by coincidence on that day I made a terrible trade.
Mm-hmm.
And so $100,000 disappears from my bank account, it shows up in your bank account, but it in no way transferred from my bank account to your bank account. And as long as you could plausibly have made this bet, there's virtually nothing that can be done legally about something like this. And you don't have to be that blatant, although from what I've been told by people in the industry, many people are, because you don't have to not be that blatant either.
So this is like, I believe the term is in accounting is like tying out. So you're like tying it out on one side. You have your, one side of the equation and the other, then it ties out. So it shows like, hey, it basically cancels each other out. But you're just basically moving money from one side of the equation to the other. But the money is technically still on the books, but it's not on the books.
Yeah, yeah, and this shows up all over the place. This is one of the mechanisms that's involved for companies that hold money overseas. There was a certain degree of repatriation. I think Trump had a tax holiday, and that got a lot back in. But many American companies that are multinationals don't like paying taxes on their money, and so they'll just hold it in overseas holdings where it isn't taxed, and then they'll use things like this. In order to be able to use that money in the districts that they want it to be. There's been some stories for several years now that debt is being kept off books by doing things like this, which, if true, would make the next financial crisis, whenever that has already happened, much worse, and so on. Um, and again, uh, this is a perfectly straightforward way to move money around. One amusing story: I ran into a woman uh, that was exploring AI techniques for regulatory technology, RegTech it's called, and she had worked with this group that had actually developed an AI algorithm that could look at stock markets and detect certain kinds of fraud happening, and not really detect, but give indications that would be very high probability investigation targets. And so that was working out. So they tried to use the algorithm on commodity markets, of training it on market activity that was known to have money laundering and other market activity that was not known to have money laundering. And the algorithm was completely incapable of ever identifying anything as good or bad. And whether that's simply because the market structural trades are so different that whatever had been being twigged in equities markets just doesn't exist, or whether uh, it's because uh, that money laundering is so pervasive in the marketplace that there actually are no clean days to provide a contrast. There's just days in which you know criminal activity is happening and days in which you don't know criminal activity is happening. Is certainly open for debate. That latter explanation was her favored one.
Yeah, I've definitely seen instances where algorithm trading is very out in the open, especially if you pay attention to the markets. Like you'll see like bad news for something come out, and then all of a sudden the stock price can go down 7%, but then it recovers by 3% really quickly. You can literally like see it like, oh, like it triggered the negative event on the down, but then once it hit a certain price, you're seeing like literally like, oh, this is a buying opportunity because it's like triggering from this sort of event. So it keeps things falling from too much, but also it prevents it from like running too high either. So what is the positive from all of this that is hopefully going to occur in the next however many years we want to look into? Because hopefully there's positives that come out of this, not just negatives.
Uh, well, so that spikiness is in fact how you get the bid-ask spread. So if the bid-ask spread of a sort of large computational marketplace is always very narrow, then the price itself has to move large distances on a regular basis in order to get uh, uh, to sort of pick off buyers and sellers at the wrong parts of those curves. And so uh, the flash crashes and things like that become much more common. So what my system does by creating a mechanism that allows for aggregation is it actually causes prices to move around less because you get higher trade volumes by having a common price understanding. And
Mm-hmm.
so what we would shift over towards is a market that is continuously projecting and planning for the future with the intent of normalizing and regularizing that future with everyone's information so that uh, basically everybody has a common understanding of where the future is going. It doesn't work that great for stocks, but it would work fantastically for physical commodities and other kinds of source sink type situations. Sovereign bonds, certain kinds of currency markets have the requisite qualities.
Yeah.
Um,
Yeah. I mean, I could see how this could be hard for, stock prices because you could have a company split and now they've just doubled the supply of the shares in the marketplace. And then that could cause a compounding effect of having those swings up and down. And then you have more people buying and selling, and then the volume increases. And then eventually these companies could, you know, could cause their price to go down. And then they just buy back shares at a lower price from someone else who's selling at a loss. And it could be quite
yeah,
difficult
yeah,
to keep
and
track of.
right, and also a company isn't a sort of known quality over time. When a new person is hired at a steel manufacturer, the nature of what is and isn't stainless steel doesn't change on a global basis. But a CEO can change the character of a company all by himself, essentially. And
Mm-hmm.
so, if you had a multi-decade plan to use something as a retirement, and the guy that was running that company keeled over and was replaced by somebody that wasn't him and didn't have the qualities that made the company valuable, then and you just were sort of hanging around with your eyes closed for 30 years waiting for everything to come back to you. There might not be a back to you to come to when 30 years goes by because it's not the same company you invested in. So all of that becomes a much trickier prospect in terms of planning and pricing versus some knowable quality of something that's going to be in demand again tomorrow and the day after that, and so on.
Yeah, and that's why I believe Berkshire Hathaway has been able to do so well is because they don't split. So they're always controlling the supply of the shares in the marketplace. They take shares of their company and they donate it to nonprofits, in which I'm sure they have a schedule on when the nonprofits have to sell the shares. They have to use it for something, and Berkshire probably knows all that information so they can reacquire the shares. And so essentially, by never splitting, they're keeping their supply fixed, and it gives them a lot more control over the share price in a publicly traded market where other companies don't do that. And that's why you see companies do what they did in the .com era, where you put a .com in the end of your name, you're worth $4 billion, and now you don't even exist.
Right, exactly. Yeah, yeah, we've seen a lot of flashes in the pan, both because of incompetence or other mistakes, or simply open fraud that have occurred over pretty in the last third of a century or so.
Yeah, and then the company's just shut down, and there's so many layers to it. It's like you don't even know who to go after.
Yeah, the Sam Bankman-Fried situation. They the bankruptcy court brought in the guy who had cleaned up Enron, and his first statement was that this is the worst thing he'd ever seen. Like Enron was a cakewalk compared to how how incredibly messed up their internal accounting was.
Does that have to do with like the blockchain at all, or just the scheme that they were running was so terrible?
Th- yeah, Enron, I believe, at some point might have done something legitimate. Don't hold me to that. That it's certainly possible that that never happened, but they might have been a legitimate company at some point, and they certainly had legitimate accounting at some point. Although they pretty quickly got into, like betting the customer money on sevens coming up to try to recoup their losses or something. But by all accounts, uh, what X, I can't remember, STX. They were basically set up as a fraud from the jump,
Mm-hmm.
and so uh, they had a backdoor into their own system to siphon customer funds into their personal accounts, or their private piece of the account, uh, and and so the entire system was built around uh, being as obfuscatory as possible, so that it wouldn't be obvious that that was what was happening. And they were all drugged to the gills, and it came up with very convoluted systems, apparently.
Yeah, I don't know all the ins and outs of it. I do know they like issued their own like token, and it was like, hey, like you invest money, you get this FTX token, but the token was just basically in exchange for we're gonna put your money into our bank account and use it for whatever we want.
Right. Yeah. Um, the actual scheme itself was extremely straightforward. They just took money that they were handed and used it for whatever they wanted to use it for. Making them look like genius investors, buying vacation property for his parents. Like it was incredibly straightforward. It's just what was made complex is that they were coming up with more and more elaborate explanations for why everybody else was doing well in this more elaborate fantasy land that they were continuing to construct, uh, uh, for pretend times to get people to keep handing them money.
Yeah, because what I remember seeing or reading was they were taking the money and they were investing into more traditional cryptocurrencies on their own. However, all those cryptocurrencies had a huge sell off, and once that happened, they freaked out.
Yeah, yeah, yeah. The illusion became unmaintainable, as
Same thing
they
happened
quite
to
frequently
Madoff in 2008. Everyone started redeeming, and when more people are redeeming than putting money in, you're done.
do. Right. Yes, he's not a genius anymore. There was a similar situation in Chicago in 2008 with their uh, apparently the city of Chicago pension fund management was, the city of Chicago is sort of well known for being extremely corrupt. And apparently the pension fund management position was the absolute bottom of the corruption barrel. Like, this is where you put the people that just couldn't even, like, sign their own names to things. And they got caught out because after the financial crisis, they they published a you know their fund state that basically said that everything was fantastic. And so people were like, oh wow, this is amazing, like these guys got hit their numbers in spite of everything that's going on. They must be super geniuses. Let's go find out what they did. And what they did was effectively Xerox the copy from last year, which is what they'd been doing for decades, because they had no idea what anything was. And so they'd just fill out the form with whatever the next number was supposed to be, and use the rubber stamp at the bottom, and then get it out the door. And so that turned out to be a hell of a mess. I remember reading the story back in, I guess, 2009 or something, when that happened.
Mm. Yeah, well, some people just can't do the right thing, and eventually time catches up with those folks because they can't keep the scheme going on forever.
Yeah, yeah. Well, we'll see. That's sort of apropos. I'm about to file my case in federal court against the patent office. They're 4 years into a campaign of insanity to delay the patent on CDM.
That's your patent?
Yes.
And what's going on there? Are you able to share it all?
Yeah, absolutely. I got a notice of acceptance 4 years ago, and um, they never sent their legally mandated withdrawal letter. Instead, they made an insane claim that they couldn't give me the patent because of what's known as a 101 violation. And this specific 101 violation, 101 is the section of the patent law that concerns patentability. So if you're a 101 violation patent, you can't have a patent because whatever you're trying to patent isn't patentable.
Mm-hmm.
Their claim turned on the further claim by the US government that one equals two, which is, of course, false. And once this was put to them quite forcefully, and they were asked to produce evidence that one equals two if they wanted to maintain this claim, they gave me a second notice acceptance 2 years ago. Uh, they actually went through the formal procedure for withdrawing that one, and then made another 101 objection that was also insane. Um, and in communication with my patent attorneys at the time, said that they were under orders to do this by people they couldn't talk about, and so that I would have to appeal. So we appealed to the patent board, and in spite of initially scheduling the hearing for next year, they actually held it this year. Um, and the patent board decided to uphold both that one equals two, and that words don't mean the words that the patent office dictated to mean what they said at the time. This was back in 5 years ago now. Uh, don't mean that. They actually mean something different from that, uh, which isn't what those words actually mean according to dictionaries or the agreement we had with the patent office. So, uh, and again, they decided to produce no evidence in support of any of this. Uh, so, that was it. Once you can get no joy from the executive branch of government, you have to turn to the judicial. And so I have filed a case with the federal appellate court for the federal circuit, and I'm getting pretty close to when my case has to get, in. I've got the form done, set up, but I have to fill out the informal petition form and get it submitted through the system. And then they'll have about a month to put together a rebuttal. And then I'll have about 2 weeks to rebut the rebuttal. And then the court will decide whether basically there should be patents or if there should be a government or if they want to grant my patent, because there aren't really any other choices that are available. If the government wants to claim that one equals two, then they're going to be among the things that aren't long for this world.
So what is not getting this patent preventing you from moving forward with?
Well, launching a marketplace is well outside of my economic capabilities. And so the most reasonable way to get this in the hands of people with deep enough pockets to use it is to sell or license the intellectual property to people like the CME Group or the New York Stock Exchange, or this new tech exchange that just started, or other similar types of institutions. But intellectual property for just ideas doesn't exist. In the absence of the patent, no such intellectual property for sale or licensure could exist. So this would effectively build a door that I might be able to get through.
What's the outlook look like? Do you have any idea?
Um, I think it's fairly unlikely that a federal judge will decide that patents shouldn't exist and don't, or that the federal judge shouldn't exist and don't. But I've been surprised by the patent office before, and so I really couldn't say.
Yeah. Yeah, you get one person who just doesn't want to be reasonable, and there's no point. There's literally no point because you can't have a conversation with them about like how you see their. I mean, it's just basically like, nope, sorry, that's it.
Yeah, yeah, absolutely. And if the court does decide that there shouldn't be a federal government, I will attempt to ask the Supreme Court if they agree that there shouldn't be a federal government. I'd imagine that they would be sensible enough not to sign their own death warrants, but who knows? Like I said, I've been fighting the claim that one equals two for 4 years.
Hmm. Well, I hope you get it.
Yeah, yeah, I hope so too. Uh,
Well, the work you're doing is important. One definitely doesn't equal two. And appreciate having you on. We'll see everyone next time.
Excellent. Bye bye.